Well, what a time to jump on together and to talk about NFT world and the crypto markets. I get the feeling that we will bleed into many categories, maybe outside of just the traditional wheelhouse of the
Yep.
NFT.NYC community, being that you are the co-founder of not just Wax and not just Tether, but several significant things in this space. William, thank you for jumping on with me. We are grateful for your leadership in the industry. For folks that don't know who you are or what you're working on today, can you please introduce yourself?
Sure. So I have been involved in Bitcoin and the blockchain broadly since, God, almost more than 10 years now. I came by this way from the video game world, where I was involved in video game virtual item marketplaces and skin marketplaces, which really are the predecessors to NFTs, what we know today as NFTs. And prior to that, I spent many years as a venture capitalist. Actually, I started or co-founded the very first consumer internet venture capital firm. It was back in the mid 90s. And before that, I was at the Walt Disney Company.
Well, you've done so many things. Thank you for giving us more of a background. It's interesting. You and I are talking about the video game market really being the predecessor of the NFT market. And even that in its infancy changed, right? As you mentioned, it went from kind of some sort of item in a video game that had utility, and eventually the main thing in video games became skins with no utility.
Right.
And so, what an interesting concept that utility became less important in that world over time. And I wonder how that may impact what happens with NFTs. But maybe just for a moment, I think a lot of people are very thoughtful about stablecoins right now. And
Yeah.
since you were the co-founder of Tether, which is considered Tether and USDC. There's a couple that people love and they count on, and they're still feel confident in, regardless of what's happened with Luna and UST. But can you just give us kind of your perspective? What's the state of stable coins? And maybe touch on how did we get here? But more importantly, where might we be going so people have a vision for what you see coming over the horizon?
Sure. So let me first just say there are three types of stablecoins. Two of those categories of stablecoin are solid and very useful. The third category has a lot more risk. So the first one, Tether, and Tether was the very first stable coin. There wasn't a concept of a stable coin before we created it. And that is a token backed by a fiat, whether that's $1, £1, €1, €1, or whatever. So it's a token that has an ability to be redeemed for that quantity of currency. Those, like Tether, tend to be extraordinarily stable. You only see them drop in value from, let's say, a dollar when I think people get nervous without fully understanding what it is that makes them stable, right? So, as recently happened, where Tether dropped to about 94 cents after Luna imploded, and but the arbitrageurs correctly said, I can buy a dollar for 94 cents, and they bid it right back up to a buck. Okay, so that's one type. The second is also collateralized, and these are collateralized by cryptocurrencies. Cryptocurrencies that they don't make. So, for instance, Make or Die is a solid project, and the DAI token, which is pegged to a dollar, right? It has its value is $1, and it is collateralized with some quantity, let's say, of Ethereum greater than a dollar. Could be $1.50, it could be $2. So you can see why you'd have some degree of confidence in that particular stablecoin. Ethereum is more volatile than a dollar. So whereas Tether is just pegged $1 deposited in a bank, you get one Tether token. With Ethereum, since it's a little more volatile, maybe it's $1.50, $2. And actually, the amount of collateral behind a make or die token can be adjusted. When volatility is quite low, it might be a buck 50 or a buck 25 for every die, and then when it's higher, it could go to $2 or whatnot. But again, it's it's collateralized, and it's collateralized by something which has some cushion built in just in case that piece of collateral drops in value. Now, the third type is essentially uncollateralized. And that is what Luna was. So Luna is a stable coin that has a mechanism for being pegged to a dollar. And it's always going a little bit above, a little bit below, and it's kept within that range by a process where there are two tokens, and the price of those tokens, in this case, Terra was one of the tokens, and then Terra UST was the other token. There's a mechanism where, depending on whether you're trying to get the peg back to a dollar and it's below it, or if it's over a dollar and you want to bring it below where it is, you allow arbitrageurs to make a small profit by being self-interested in doing what they're doing, but by finding a way to make a little bit of profit, they keep that token in line. And the problem with this is it requires a lot more complexity. And of course, you have to rely on this third party, these arbitrageurs, to behave in what you think is a proper way. And they have to believe, the arbitrageurs have to believe, that there's only profit in doing what they're doing. There's no risk to their underlying capital. What happened with Luna was Luna lost its peg, and the arbitrageurs either might have aided in it dropping further and further from the peg, or maybe given up at some point. But at some point, it began a spiral downward. And what Luna was attempting to do was print more Terra tokens as its own collateral, and backing the Terra UST with more and more Luna tokens. And every time they did that, people said, "Oh, you're diluting the value of Terra, right? Because the quantity of Terra outstanding is going up." And so they'd have to go back immediately and issue more Terra, and then people would get further disappointed, and so on. And eventually, we went from 350 million or so Terra tokens a few weeks earlier to 7 trillion Terra tokens right before it all collapsed. So algorithmic, that's what these are called, algorithmic stablecoins, which are not backed by independent forms of collateral, are novel, and they have a lot of risks. And when they get unpegged, they can quickly lose their value. And this is why I think it was a very unstable token. Just maybe a lot of people didn't understand that, and so it looked good for a while, but they weren't comprehending the risk. I would liken it to, walking blindfolded across a busy highway and getting to the other side unscathed, and doing that many times, and believing you must not be taking any risk because nothing's happened. But in fact, the risk is there; it just hasn't struck. And so I think a lot of people who were very scared of what was going to happen to the other stablecoins, to the extent they investigated it, they saw, oh, these are fundamentally different mechanisms used to keep that token pegged to a dollar. And in the case of Tether or USDC, I think we have a lot more confidence in them. And frankly, just the passage of time. Tether's been around since 2014. USDC, I don't know, 2017 or something. But that in itself means something, right?
I have a quick question on stable coins, if you don't mind me jumping in, because I think people are wondering this that haven't yet, put any of their net worth in stable coins. When is it best to use this as a financial instrument?
Okay, so Here's something to keep in mind. Stable coins are like the circulatory system of crypto. They are necessary for the free flowing of crypto operations. Uh, in the case of Tether, it does upwards of 50 trillion US dollars in transactions annually, right? 50 trillion. What is going on there? Well, half of all Bitcoin trading pairs across all exchanges are settled against Tether. Tether is almost always, if a token is being listed for trade, it's the top. It's generally the top token that token will be traded against, or number two behind Bitcoin. So people do that for a very simple reason. It's impossible to arbitrage effectively when you don't have one of the two pairs being traded that is stable. Because if both tokens are moving like this, it's kind of hard to figure out if you're profiting or not, right? So you need one of them to be stable to calculate your gain or loss against. And so stable coins are very important from that perspective. Also, people sometimes get nervous about volatility in the crypto markets. You can very quickly move from a Bitcoin or a Wax or an Ethereum or whatever token you're in to a stable coin and sort of let that be your safe harbor and then immediately get back out. The alternative before we created Tether was you had to do all kinds of machinations to get your Bitcoin or get your tokens, if they were in altcoins, to a Bitcoin, which was then deposited on one of the few exchanges that had banking access. And then you would go and get that thing converted into fiat. And generally they were pass-through entities, so they'd have to send you and wire you that money. By the time you got it, you weren't nervous anymore. You wanted back in. So Tether provides, and other stablecoins provide, a very rapid mechanism to eliminate the volatility that you're facing if you don't want to be facing that at the moment. Of course, it's also the only way you can effectively build a blockchain-based payments network. Bitcoin is perhaps one of the worst payment networks ever built. It does many great things, but a payment system it is not. It's not because of the cost and the variability in the cost, and because of the latency in the system, which could take 10 minutes. So while it was invented to be a payment system, it's actually a very poor payment system. But if you were to do it, if you wanted to build a blockchain-based payment system, you would use a stable coin like Tether, and you would use a blockchain that was proof of stake or delegated proof of stake like Wax. And therefore, you could move things rapidly with very low cost to do so. So that is how all of these blockchain-based payment systems ultimately will gravitate to. They will gravitate towards payment networks that are stablecoin based.
Well, I'm glad we talked about this, because I feel like the NFT community, unless they've been around for a while, if they're new, they may not really understand the benefits of using stablecoins. And now people may just bundle in Luna with all stablecoins, which certainly should not be done. For folks that are not aware of Wax, I think most in our industry are, but can you give a high-level overview of Wax, and then maybe we could talk about magnetic for one moment before we wrap up our conversation.
Thank you for that. By the way, Ian, I'm going to quickly send a message to somebody, but I figure we can edit this, right? So hold on one second.
Yeah, you go for it. So while you do that, let me actually read to people what your talk is. I think a lot of people are looking forward to hearing you share. And so you're going to talk about NFT 2.0, the evolution of digital assets from gaming to commerce. And so the description is the NFT revolution is here. We're already experiencing NFT era 1.0 and 2.0. Together in this talk, you'll explore how consumers will experience NFTs in the next 2 to 5 years by looking at the origins of the NFT industry. And so, last year when you spoke, people really responded well to that. I think that there's an appetite for hearing from you, not just because of what you're doing and what people anticipate you will do in the future, but because of what you have done. So back to my question, which was, can you just give some insight on what is Wax for those that haven't participated and done any projects with it or collected from it? And then maybe also the VC firm that you're helping lead as the managing director, Magnetic. I think it'd be nice for people to know about the things you're working on.
Sure. So Wax came out of the work my partner and I had been doing for many, many years in the creation of video game virtual item marketplaces. First with those, and then with video game marketplaces for skins. A skin is a video game virtual item that is has no in-game utility. It's strictly a cosmetic in the game. So we had done both of those. Now, we were doing those marketplaces without a lot of cooperation from the video game industry, because video game industry didn't really like the secondary market trading. I thought, and I would explain to them often, that a very robust, liquid secondary market of their in-game items helps to promote a healthy and growing primary market, which is how they make all their money. But a lot of companies still don't like the idea of somebody, a third party, allowing people to trade their virtual items. So when we, probably around 2013 or 14, we thought one day we should try to do video game virtual item trading and skin trading on a blockchain. But at the time, the consensus mechanisms, the process by which you validate a transaction on a blockchain, they were too slow. And then in about 2017, a guy named Dan Larimer, who has created a lot of very important technology in the blockchain, came up with this concept of delegated proof of stake. It's a fantastic consensus mechanism design. We saw it, and we decided that was the right time to launch what would become WAX, which stands for the Worldwide Asset Exchange. So WAX was the first blockchain purpose-built for NFTs and other media files that would be traded on a blockchain. Also for blockchain video gaming. We wanted a blockchain that could accommodate very rapid buying and selling at very low costs, and actually would be approachable for people who understood video games and video game items, but weren't familiar with blockchain. And in 2017, there was still very few people who were using blockchains. And so I remember when we announced it, I was in London announcing the creation of Wax. And in the audience, I noticed a lot of people didn't really understand what I meant when I said video game skins. And I realized, wow, a lot of the early people in crypto came from my industry. But over a few years after that, a lot of people were in it who didn't really know much about video gaming. So they didn't know how popular skins were, how hundreds of millions of people globally trade skins every year. And they thought, well, why can't you just use Ethereum? And well, I'd been involved in the early days of Ethereum as a second largest buyer in their crowd sale. I had also been involved in the predecessor to Ethereum called Mastercoin, which was the first attempt to put an intelligent layer, a smart contract layer on a blockchain. So I had a very good understanding of what Ethereum could do. And Ethereum's great for a lot of things, but not consumer mass market applications. That ultimately became known in 2021 when NFTs really ramped up, and people saw that the issue is the way Ethereum clears its queue. It really applies what most people would recognize as the surge pricing model that Uber uses, where the queue is cleared by having those willing to pay the most money get their transactions processed first, which works, but it's not very dependable if you want to reliably be trading at a certain price, and you go from $1 to $100 randomly, it seems, just as congestion goes up and down. So I knew it wouldn't work, and so that's the reason we thought we would do Wax. And Wax was conceived of not just as a blockchain, but also as a wallet, a cloud wallet. And the Wax Cloud wallet is still, I think, the best NFT wallet out there. We have now over 12 million people using it. By the way, in January 2021, there were about 400,000 Wax wallet users. So we went from that to 12 million in a little over a year. And it goes to show how much growth there was in NFTs between early January and then and 2022. And so we also have marketplaces, of course, that are easy to use. We even created the Wax Atomic NFT Standard, which is which was how we thought about what people would ultimately want to do with NFTs. And NFTs are not just media files, images, or video snippets, or music snippets. They're much more more comprehensive to that. They're really just Turing complete computers. And so we knew that you would need a blockchain that also had the entire ecosystem of capabilities built around it. So that took about 4 years. And Wax today has more transaction volume on a daily basis than any other blockchain. And last I looked a few days ago, it's about 20 million, but it ranges between 20 and 25 million transactions a day. To put that in perspective, something like Ethereum might have 1 million transactions a day. And the reason is Wax really appeals to people who want to do broadly used smart contracts, things where maybe the average item, the average NFT would cost $5 or $10, not $500,000. If all you're going to do is $500,000 Bored Apes, you can probably do that on Ethereum because no one cares whether they pay $1 or $100 for a transaction. But when you're going to use a blockchain for an NFT sale, like what we did with the Topps trading card company for baseball cards, the average Wax Topps baseball card pack, it had 5 NFTs, was like $20. So if that's going to cost you $50 in fees to buy a $20 item, it doesn't make sense. And so you think of Wax as a mass market blockchain. And so far, I think it's worked the way we intended because there's more transaction volume on Wax than any other blockchain.
Well, what a fascinating conversation it is for me. I love hearing your perspective, especially off of a big stage with a big crowd and lots of energy, where it feels like maybe a little more paced. I'm also thoughtful of time, so we probably should wrap up our conversation. Before we do so, I'd love to hear about your VC firm. What type of entrepreneurs or organizations are you looking to deploy capital to, and how should people investigate that Magnetic?
Sure, Magnetic is a fund. Right now, we don't have outside capital. Capital is from the family office of myself and my partner, and we both do third-party investments. Obviously, since we're very interested in the NFT space, we do a lot of investing in that area. But we also are very interested in infrastructure. We did a lot of infrastructure investing in the first, maybe 2011 to 2015 or so. And then it seemed like there was enough infrastructure needed to do what was necessary. In the last 2 years, I've realized there's going to be a renaissance in the infrastructure area of blockchain. As more and more people are using it, we need better capabilities. And so now we both incubate and invest in things you would broadly call blockchain infrastructure. And then, of course, into the kind of midterm future, when augmented reality will be available, consumer priced, long battery life, wearable technology for augmented reality, we're looking at that very closely and are making investments in that area. And so those are broadly kind of what we do. Call it NFT, metaverse stuff, infrastructure related things, and then augmented reality.
Well, thanks for putting your capital back to work in the industry. Really, really cool career that you've had. And I think that a lot of people will lean on you at NFT.NYC, not just this year, but all of the future gatherings for your wisdom. You just have so much experience. You explain things in a real calm, articulate way. I think people appreciate that in the midst of maybe more of an anxious type of atmosphere that people feel. So thank you for bringing that calm wisdom to us today. And we look forward to seeing you next month in Times Square at NFT NYC. Thank you so much, William.
Well, thank you.